Good morning and welcome to this Monday, April 5th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we look like we're going to get off to another pretty good start this week. Big jobs report on Friday. If you didn't get a chance to see it, I know it was a holiday. We'll go through some of those numbers, but the numbers were very encouraging, not just for the March non-farm payrolls that were released on Friday, but they also revised February numbers higher. So pretty good numbers out of the jobs area. Got the 10-year Treasury yield on the rise, and yet NASDAQ starting to take leadership here recently and this morning again after it looked like they were going to have a little relative weakness at the open. I have seen the futures pick up a little bit here. So I don't know, it'd be interesting to see because there's been so much hype about higher interest rates and how that's going to kill technology. And yet technology, as earnings season starts to come into focus, beginning to lead again. But we'll continue to look at all that. Got some interesting charts for you to take a look at today. But let's go ahead and get started. First thing, I'll take you over to Earnings Beats, as I always do, especially for our newer folks. Just to let them know that you can sign up for our free Earnings Beats Digest newsletter. It is published 3 times a week, Mondays, Wednesdays, Fridays, in the morning, normally before the market opens. All you have to do, type in your name, email address, hit that subscribe button, we'll get you added. There is no credit card required. It's completely free, and you may unsubscribe at any time, so we'd love to have you. Starting to make a little bit of a comeback on our portfolios this quarter. Of course, since inception, our portfolios have been extremely solid. This quarter has been rough. Money rotated away from growth stocks, and 3 of our 4 portfolios are heavily invested in growth and technology, consumer discretionary, and those areas have been out of favor this quarter. But we are starting to see that change and shift a little bit. And as we move closer to earnings season, that will probably be my focus, is looking to see whether or not that rotation back to technology and back to consumer discretionary, whether or not that continues or not. The bullish part of all of this is that the aggressive groups are leading. When we've seen the rotation away from technology and maybe to a lesser degree away from consumer discretionary, we're seeing a lot of that money rotating into financials and industrials. So it's just, passing the baton on to another group to help lead us into this next phase of the bull market. So I find it very bullish. And so the question going forward is just which of these areas is going to outperform. As I've said over the last several months, that to me is the biggest question. It's not whether the market goes higher. The market, to me, appears poised to go higher, a lot higher. But the question is, among rotation, which areas of the market are poised to lead? And that is still up for some debate. And I think earnings season will help straighten some of this out. All right, moving on. Well, Thursday's action, of course, market was closed on Friday, had a holiday shortened week last week. But Thursday, you can see the Dow Jones Industrial Average closing up 172 points, 33,153. The S&P 500 up 47 points. That's up more than 1%, breaking out above 4,000 for the first time in history. At the beginning of 2020, we had a market vision event with a number of our friends and colleagues over at Stock Charts. And we all got together, talked about 2020 and gave our predictions. And one of my predictions, I know it was a wild one at the time, at least a lot of folks thought it was wild, was I expected the S&P 500, I did a little play on numbers, but in 2020, I said it would close at 4040. And that may have seemed a little outlandish at the time, and especially after the pandemic hit, and we went down to 2191 at the low, just a little over a year ago, 2191. And yet, look at where we are now. S&P 500 closing above 4,000, getting close to that 4040 target. I may have been 3 months late, but with a 100-year pandemic, I don't think that was too bad. And I think without the pandemic, we would have been there. NASDAQ up 233 points. This is what the outperformance or the shift back to technology I was talking about. We did close back above both the 20-day and the 50-day on the NASDAQ. So The NASDAQ, at least technically, and I'm going to give you some more charts on the NASDAQ in just a minute, but at least on the charts, technically in the short term, things are looking up. And I don't know if you're paying any attention to the accumulation distribution, but I do. Look at all these indices. Okay, you got the Dow, S&P, both up there setting new highs or right at new highs. Mid cap's not far. Small cap's starting to turn back up, not too far away. The one that's furthest away from its high is the NASDAQ. Yet look at the AD lines. NASDAQ is the only one breaking out to a new high. So while everyone is selling and all the fear was building on these technology stocks, so, technology's run is over, these stocks are overpriced, blah, blah, blah. Who in the heck's buying them during the day to send the AD line higher? It sure does smell a lot like March of 2020 to me. And that's what I've been talking about. It seems like a lot. And, I went through, I think 2 weeks ago on the weekly portfolio report that I do every Sunday for Earnings Beats members. And I pointed out some of the stocks that are showing really strong AD lines, even though price action's been coming down. And I don't know if you've been paying attention, but some of those stocks are really starting to come back now. So all of a sudden, and today, well, we'll get into the 10-year Treasury yield in a minute, but the yield's up, and all of a sudden, technology seems to be just fine. Things that make you go, Sectors. Here were the top 5 sectors on Thursday. Energy up 2.5%. There's your technology, 2%. Communication services almost 1.75%. Real estate 1.6%. Financials about 1.25%. The good news is that all of these areas are still in uptrends, and some might argue technology is not. I would just say look at a weekly chart. When stocks go up fast, you got to keep everything in perspective in the stock market. When you've got a group like technology that's been leading by the amount that it's been leading over the past few years, when it does pull back, it tends to be a little bit more violent because you've got more profit taking, you got more sellers, you got people who are buying at the top, panicking out. So you got a lot more wiggle room, if you will, to the downside without the chart breaking down. I know you look at the daily chart and say, well, look at this. It was a huge move down. Well, we were talking about an ABC correction. I mean, we saw it in the NASDAQ right here, ABC. Same thing in technology, ABC. Now we're starting to turn back up to the upside. I just think you have to be careful when you just look at a daily chart, because does this look bad on the daily chart? Of course it does. We broke below the 50-day moving average. The PPO is negative. But when you look at it on a weekly chart, it's a completely different picture. Anyway, communication services heading higher, real estate higher. And here's financials. This is what I was talking about. Do you see the move up in February and March right here? Look at technology moving down. All it was a passing of the baton. Technology said, here, financials, you take over for a little while, lead this bull market, I'll be back. And now we're starting to see technology turn back to the upside and financials just going sideways. But the good news, at least from my standpoint, is that it's the shift here is taking place at a key level on technology. I mean, we've got, and when I say key level, I'm talking about more on the weekly chart, where we're breaking it back up above the 20-week EMA. Actually, I don't think we went below it. I think we just tested it. But now we're starting to turn back up off of a test of that 20-week EMA, which I think is really bullish. All right, let's keep moving on. 10-year Treasury yield. All right, let's get an update. Still got an issue here with negative divergence, by the way. So we're trying to go higher on the 10-year Treasury yield, but that PPO tells us we probably need at least a period of sideways consolidation, maybe even a pullback in the yield. Either way, I think that would bode well for technology. But today, we're up 5 basis points. And from earlier this morning until when I just looked a few minutes ago, NASDAQ starting to strengthen again on a relative basis and may even lead at the open. So what's changed? Why, with interest rates moving up, why is technology not a bad thing now, like it was a week, 2 weeks, 3 weeks ago, 4 weeks ago, whatever? There's a lot of conflict of interest in the way many of these financial, Wall Street firms operate. I'm not going to get into all that again, but I think it behooves them sometimes to have a certain theme and narrative that they promote, while building positions for institutional clients. That's, again, just my opinion. I have no facts to back that up. Just looking at history and the way that, relative strength works, and you go through periods where technology is out of favor, and then all of a sudden nothing changes except the chart, and then all of a sudden technology is back in favor. But we did have, like I said, the big non-farm payrolls report on Friday. Non-farm payrolls for March came in at 916,000 jobs. The estimate was 658. 916,000 versus 658. March private payrolls, 780,000 versus 550,000 estimate. March unemployment rate, right as expected at 6%. And here's another key. March average hourly earnings expected to rise 0.2%. They fell 0.1%. So when we talk about inflation, of course, you have price inflation, but you also have wage inflation. And with unemployment rate still at 6%, there's still a lot of room to hire and to put more and more people to work. So at this point, there's still not that much pressure on wages. You don't have to pay more to get people. People are out of work. People are still looking for jobs. So I think it's important, with this whole inflation talk that we're hearing, to understand that average hourly earnings are not going up. So the wage component of inflation is just not there. And then also February non-farm payrolls revised higher from 379,000 to 468,000. So it really was a great report in terms of the economic outlook. That's one of the reasons why you're seeing the 10-year Treasury yield today up 5 basis points. Strong economic news. That's why we've been going up off the bottom, is the bond market's been anticipating this. So you got sellers in bonds, which is driving the yield higher. Well, what are those bondholders that are selling? What are they doing? Well, the S&P 500 just went above 4,000, first time in history. Back end of last year, I said, watch transports, watch small caps, and the bond market. Those were the three things. Small caps took off, transports breaking out the new highs, and we've seen money rotating out of the bond market. I was asked, what's going to drive the stock market higher? What could possibly drive the stock market higher? Those three things, and all three are moving back to the upside. So I think we're going to see higher Treasury yields, and that's not bad for growth stocks, not in an environment where the GDP is expected to climb the way it's expected to climb. If we were still talking about a GDP of 2%, and interest rates were really starting to pick up momentum like this to the upside, and, we were looking at 2.5%, 3%, that would have a little, more of an impact, certainly. I don't think that rates going higher, I would absolutely take higher rates. I want the 10-year Treasury yield to get up to about 2.5%, because that tells me that the economy is so strong that everyone is bailing out of the bond market. That's the bubble. The bubble has been in bonds for the last 10 years. Sending our yields down to 0.4% on the 10-year Treasury, sending global yields negative, that's the bubble, the bond market, not the stock market. All this money coming out of the bond market is going to head into the stock market. We're going a lot higher. All right, let's move on and talk a little bit about, obviously here's the QQQ, tracks the NASDAQ 100. But the thing I wanted to point out, a couple things here. First, here's your A, B, C correction. Very typical in an uptrend to see a move down, a bounce, and then another move lower. It scares everyone, gets everyone, that's when you start seeing the articles coming out saying the NASDAQ's dead, technology's dead. It's not dead, and we're starting to break back out to the upside. The other, in addition to the ABC, is this left shoulder, neckline, head, neckline, right shoulder, breakout. So let me annotate that. I just want to make sure everyone sees that, especially if you're not really a technical analysis fan. Hopefully you'll become one. But here, you can see just a slight, just a slight close there. All right. There we go. Just a slight close on Friday. Of course, we've got futures higher this morning. But seems to me like we're making this breakout. And that's a really good thing, because off of an uptrend, I look for continuation patterns. A lot of folks see it breaking down and just look negative and go right into the bearish scenarios. I give the bulls the benefit of a doubt in a secular bull market. I look for the bullish patterns, the bullish continuation patterns. When I see an ETF like this that tracks one of the major indices, or even some of my favorite stocks, when they pull back, I look for continuation patterns. And so here you've got an inverse head and shoulder. Head and shoulder is a topping pattern. An inverse head and shoulder is a continuation bullish pattern. So you've got this pullback and then you bounce. You establish a resistance level. You go down one more time, taking these prior lows out, looking bad on the chart, PPO negative, down below the 50, down below the 20. The 20 crosses over the 50. We got a bearish cross or death cross. I mean, this is just horrible stuff, right? Just as all this is happening, we bottom. Just when everybody starts getting negative, the death cross, momentum's getting, it's horrible to the downside and so forth. Then we come back up. Now, what you normally would see, and this is one of my first clues, what you normally would see in a really, truly bearish pattern is a move to test the 20-day and then right back down to a new low. But we didn't do that. We went all the way back up here and tested this prior high and then came back down. And of course, we're back down below the moving averages. That's horrible, right? Well, not in this kind of pattern. It's not. I mean, we're just going back down really and testing the left side of, left shoulder, 310 level. And now here we come. Now we're back up above the 20, back above the 50 and breaking out above these prior highs, moving to about a 6-week high in the QQQ. And look at the PPO moving positive. It finished just barely positive. And the way you can tell that is it gives you a reading right over here next to the 1226.9. That 0.005 is black, meaning that it's positive. If it was minus, you'd have that red. Or actually, I think it probably still would be black, but you have the minus sign in front of it. Anyhow, I think that the action here looks pretty good to me, and I would suspect that we're going to continue to run here into earnings. And I got a couple of interesting stats for you in just a second, but I'll show you a chart of the XLK as well. So here's technology. So there's your move up. Here's your ABC. Also, left shoulder, neckline, head, right side of the neckline, right shoulder, almost perfectly symmetrical with the left shoulder. And there's your breakout. And that one's a little clearer above the neckline. So great action here on technology. Now I'm going to go back to the NASDAQ here for 1 second. And I want to just go over some numbers now. In a recent article that I wrote, and I was looking for it before the show, I couldn't find it. I write so many articles, and maybe it was in Daily Market Report, I'm not sure. But I wrote an article somewhere that discussed the performance of the S&P 500 in the first half of the calendar quarter versus the second half of the calendar quarter, and how the first half is much more bullish if we go back and we look over the last 70 years. Well, I updated the NASDAQ, my NASDAQ historical spreadsheet over the weekend. I had actually fallen behind on it about a year or whatever. So I updated all the way through the close last Thursday. And then I went and did that same exercise. And it was even more pronounced, much more pronounced on the NASDAQ. So as you're looking at this chart, I'm just going to give you some numbers here. These are annualized returns of the NASDAQ since 1971. So we're talking 50 years, 5 decades. January 1st to February 15th, the annualized return on the NASDAQ is 28.15%. But from February 16th to March 31st, which is the period we just ended, the annualized return is 3.81%. 28% versus roughly 4%. That's the annualized return looking at the first half of the first quarter versus the second half of the first quarter. You need to know that. That's important. This isn't, we're talking about over 3,000 trading days in this analysis. 253 trading days is a year. So 3,000, that is a dozen years worth of data. That's a lot of data. You would think that over time, it would just kind of work out and be kind of even. January 1st to February 15th, 28% annualized return on the NASDAQ. February 16th to March 31st, 4%. That's a big, big difference. Let's go on to the next quarter. So now we've got April 1st to June 30th. Of course, we're just starting April 1st. April 1st to May 15th, 16% annualized return, 16%. May 16th to June 30th, 8%. So the performance over the last 50 years, the first half of this quarter is double what it's been the second half of this quarter. Now, does that mean that we're going up the next 6 weeks? No, it doesn't happen every quarter. But the tendency, I mean, if you wanted to talk about odds, I would say yes, the odds are greater that we're going to have a pretty good next 6 weeks. And then you get past that first half of the quarter, and you've got to be a little bit more careful as you go into the second half. And the reason is you're getting past earnings season. A lot of anticipation. I've been pointing out a number of stocks. I did it again this morning on the Earnings Beats Digest. If you've signed up, it was NextGen, NXGN, which is a healthcare stock, but it's a software stock in healthcare. Anyhow, it's a company that tends to do really well, and I can bring up the chart here quickly. But it's a stock that tends to do very well. This was heading into its last earnings report right there. Here was the earnings report before that. And here was the earnings report before that. This is typical of what the stock market does. It anticipates earnings. Here are the earnings. Buy on the rumor, sell on the news. Buy on the rumor, sell on the news. Buy on the rumor, sell on the news. Well, NextGen reports in 4 weeks. Are we going to see buy on the rumor? If it's going to be a good report, I think we're going to see buy on the rumor. If there's no buying going into the report, chances are it's not going to be a very good report. I also wrote recently about Tesla and Shopify. Shopify, I think, was in one of my articles that I wrote. I don't know if it was Chart Watchers or in my Trading Places blog, but I literally just sent it out last week. And in the article, well, I'll look at Shopify first. So here's Shopify. I mean, we were down near 1,000. I don't remember which day it was, but this is a stock that has averaged going up, I want to say like 40% in the 4 to 5 weeks before earnings, going back the last 5 quarters. So I think it really is important to understand that as stocks move toward their earnings reports, if Wall Street is impressed with their meetings with management, and if Wall Street considers these stocks to be leading stocks, you're generally going to see a move up heading into earnings. So is this the start of something big for Shopify? I don't know, but I like technology. I don't think earnings are going to be bad. I think earnings are going to be really good. So yeah, I think it's very possible this is starting. We got to close finally above the 20-day moving average. It's been 6 weeks. We did that on Friday on Shopify. I looked this morning, last time I looked, Shopify was up $20 in pre-market. So I think it was like 11.75 or something like that. A move back through the 50-day would be very encouraging on Shopify. And then in that article, I encouraged folks to join our EB Digest because I was going to talk about another stock that does even better than Shopify heading into its earnings report. And that's Tesla. Tesla has averaged almost 50% gain over the 4 weeks heading into earnings. The last 5 quarters. And I went back, it even goes further than that, but I just did 5 quarters. I think the average was like 47% or 49%, something like that, over an average period of about 4 weeks. Well, I think Tesla reports on April 27th. So this low that we just saw a few days ago would be the start of this period. Tesla's up $50 this morning, by the way. Had some numbers that came out on their vehicles, their deliveries and all last quarter or last month. I'm not sure what, but Tesla was up $50 in pre-market. And I can tell you where it is. It's $45 to 707. And if you didn't know that, by the way, this has been here now for a while, but on the drop-down menu, if you go into symbol summary and then type in your symbol, you can do anything. So we'll take a look at Shopify. Yep, $22, 1178. So that's all you can do. That's all you have to do to get pre-market or aftermarket information. Anyway, Tesla, you can see going into its last report here, Look at the move that it made. Buy on rumor, sell on news. In October, this one was not particularly good, but here was your buy on rumor, sell on news. How about June? From here into July, buy on rumor, sell on news. So when you look at this, and then let me pull up the NASDAQ again, or QQQ. Whoops. So when you start looking at the market, understand, when I'm reading out these numbers, the first half of one quarter versus the second half, the earnings generally come out from the middle of the first calendar month in a quarter. So January 15th, April 15th, July 15th, October 15th. That's generally about the start of earnings season. Now, that's just the first handful of large banks that come out the first week for the most part. Then you start getting into some of the large technology companies that'll start to report in the second week of earnings season. But earnings season basically spans for a good 4 to 5 weeks, starting, like I said, right around April 15th. We'll go until about May 20th. That's when you'll get most of those earnings reports. And so it's all of this buildup into earnings and then the actual earnings, and then sell on the news. That's the bigger picture of what happens in the stock market, which I think is really important to understand. So that's the second quarter breakdown. Third quarter breakdown, July 1st to August 15th is a positive 2%. August 16th to September 30th is minus 1.3%. So a little closer to even, but definitely still favoring the first half. The only month, just like with the S&P 500, the only quarter where we see this flop is October 1st to November 15th, 12% on the NASDAQ. November 16th to December 31st, 17%, almost 18%. So both halves are good. Second half there is a little bit better. And I think part of that's the holidays. I think it's Santa Claus rally. We don't see that third month weakness in a quarter like we do with March, June, and September. We don't see that nearly as much in December, although we do with technology. That's getting a little ahead of myself. Technology tends to struggle in December. Anyhow, those are just some numbers to think about. Like I said, I updated that over the weekend, so I just wanted to point out that it's not just the S&P 500, it's the NASDAQ. It's the way the stock market works. Long-term buy and holders, who cares, right? Doesn't matter. You're buying and holding through everything. Traders, that's like gold. That information is gold to a trader. Everybody that just trades all year long, like every day is the same, you don't have the best odds because you get frustrated. Look what just happened in March. That was another reason why I did not believe what was going on in March. I know historically March is not a good month for stocks in general, and certainly not for technology more specifically. All right, just a couple things. Earnings, not really anything to talk about today. I will tell you that this week we got paychecks coming up tomorrow. As I look ahead, Constellation Brands is on Thursday. I mean, really, there's not much coming out in terms of big earnings reports this week. Next Wednesday, April 10th, then you're going to get JP Morgan, Wells Fargo, Goldman Sachs, and First Republic, which is a bank out of San Francisco. But anyway, those four banks, especially JP Morgan and Wells Fargo, they're going to be big for the banking area. Investment services, of course, Goldman Sachs. But that's when the earnings really start to kick in. And I said the 10th. It's not the 10th. It's it'll be the 14th. Wednesday the 14th is when those companies report. All right, let's see. Just a quick look at the I did want to show you one other thing. Look at this pattern. It's a beautiful pattern, by the way. Inverse head and shoulder on Cleveland Cliffs. Move up, left shoulder, neckline, head, neckline, right shoulder. Look at that reversing candle on the right shoulder, and boom, to the upside. Look at the volume coming on that breakout. Really nice chart. Now, Cleveland Cliffs may pull back, because it has gone up quite a bit in the last 6 trading days. But any kind of a move as it approaches, say, 18 and a half, and if it got down anywhere close to 20-day for sure. But any kind of a pullback here, I think would be really interesting on Cleveland Cliffs. I expect, and the measurement here, by the way, is from, let's just say 13 to about 17 and a half, $4.50 to be 22. So if you get it back in the 18s, just the initial measurement would be to 22, which I think would be a pretty good trade on CLF. All right, how about relative strength? So here's technology. Remember, breaking down, going to look at this is the relative chart, weekly chart of technology versus the S&P 500. So this isn't necessarily saying that technology is going down, although we know it did, but it went down relative to the S&P 500. Look at the relative PPO for the first time in a couple years, getting back to the zero line. That's good. This basing and all is good. I think it's really possible that technology launches from here back to the upside. We'll see what happens. But that was a relative chart that I wanted to show you. And then when you look at consumer discretionary, look at the hit that consumer discretionary took in February, bouncing back on a relative basis in March. But its PPO on a relative basis went below the zero line. I think this is setting up opportunity for both of these groups. Communication services took that hit in March, trying to bounce back. Now here are the industrials and financials. Look at industrials picking up the slack. This is what you want. You don't want groups. I mean, March tends to be a pretty good month for some of the defensive areas. You know, utilities, real estate, consumer staples, they tend to do well on a relative basis in March. Some people are saying, oh, well, the market's turning defensive. This is bad for stocks. The market almost always turns defensive in March. Nothing new. So just, again, understand history. I think that helps in trying to wade through what's been a really tough market over the past 6 weeks. And then finally, financials. Look at the financials. I mean, that move really all the way off of the November low, and that's when the vaccine news came out. Once that positive vaccine news came out, financials just rolling to the upside. Really strong action here. All right, the three you must see. I'm going to go ahead and show you first United Health. United Health making a big run. I'm going to update it, just see. I think we're pretty close to a support level, and I can annotate this and show you. See this top? Well, we made the breakout, went up to 380 after breaking out above 360. We came right down and tested the mid 360s on Thursday of last week. We still got that rising 20-day. Maybe we get down there, but I think we're at a pretty good area of support on the UNH. So even though, healthcare, not one of my favorite areas right now in the market, I'm really focusing much more on the aggressive areas. I think UNH does look pretty interesting on this pullback for those maybe who are looking for something a little bit more stable and not so crazy in terms of volatility. The next one I want to bring up is PDD, and looking for a breakout above the 20-day. Until I see that, I would be really careful. PDD, when you look at the relative strength, I mean, everything on this chart right now does not look good. It's part of broadline retail, which has not been good. It's relative strength versus the S&P, not good. Relative strength versus broadline retail, not good. So you got a weak stock over the last 6 weeks in a weak group. You've got AD line pointing lower. You've got the technical action all taking place under the 20-day. I wouldn't touch this stock until we at least get a breakout above that 20-day moving average. We had a chance on Thursday and then failed. And now we're right back at Thursday's open. So PDD, this is the way I would evaluate stocks that are in downtrends. Now, keep in mind, this is not a bad zone. I actually think this is a stock that's likely to turn from here. Here was the earnings right here. Earnings gap up, and look, notice the tail that day. That marked the lowest the stock went. That's where buyers jumped back in on very heavy volume. So that's a pretty important level. Then you've got the bottom of gap support right here. If you notice, the low that we saw here came right down basically to the top of this support area and then turned back to the upside. That could be it. But if we go back down, maybe one more time, there might be a positive divergence on the PPO, something I would look for. But it would start to become a better reward to risk play, even though it is in the downtrend. I don't want to buy it right below the 20-day because this could be the failure. Just like, look at what happened if you got excited bought on the 20-day here, or you bought back here on this gap up at the 20-day, look at the pain that you would have been through. We don't know what's going to happen from here. Technically, this could be the sell area where PDD takes another big drop to the downside. And while I'm really bullish about technology, maybe I'm wrong. I mean, there's no guarantee I'm right. Maybe technology rolls back over, and maybe consumer discretionary like stocks, PDD, maybe that rolls back over. So you gotta be thinking with at least a little bit of skepticism when you go into these positions. You've got to be looking at both sides of the trade. And here, this is not the area I would buy. Now, if it can break out, I know maybe to some of you may seem really weird, but if this stock were to break out and close at 150, I'd rather buy it at 150 than at 140. I'd rather buy it when it breaks through a technical area of resistance. All right, last one is NVIDIA. NVIDIA is starting to strengthen, at least at the end of last week it was. Gapped up a little bit today, pulled back, now back up near the high. But this is one that's been in this sideways. We've seen so many stocks like this. I'm thinking like Amazon. What are some others? Netflix, Facebook. Facebook's been strengthening, trying to break out. But NVIDIA, just sideways action. And it's part of the semiconductor group, which has gone and printed a new high. So on a relative basis, NVIDIA is weak versus its peers. So there's a lot of things going on here. But AD line remains very strong. We're getting ready to break out again. So I'm not giving up on NVIDIA. I really like the group. I'd like to see some relative strength. I want to see it start outperforming its peers. Part of it's the reason it broke out is because semiconductors broke out to a new all-time high. So you look at NVIDIA and you say, well, yeah, it looks really good. Well, it does, but there's still that relative weakness that it's got to work through. So it's looking better. I do like the AD line, but we still got to work through some of the other relative weakness issues. All right, that's it. Take a look at the market. Looks like all the major indices are all up about 0.8%, maybe to 0.9%, really strong. We are seeing the VIX up. Look at where the VIX is at now, by the way. Couldn't go below 20 for a long time. Today it's up 3%. It's still down at 1788. One last warning. We're going to have inflation numbers coming out. I think it's on April 13th. We'll be talking more about that. But the headline number is going to be bad. I mean, just the way it's calculated, it's going to be bad. And so if there's going to be a spook, again, to technology stocks, it's probably going to be when that report comes out. But anyhow, one last thing, and we'll wrap up. I got to see what Tesla's doing, see if it's gapped up to 707, sitting at 702, up $40 today. But this could be part of a much bigger pre-earnings run. We'll see. Listen, everybody have a great day. Be back tomorrow over at Stock Charts TV for your next episode of Trading Places Live. It'll be a recorded version, but hopefully you can join me. That'll be at 9 a.m. Eastern tomorrow over at Stock Charts TV. Everybody have a great day. Happy trading.